Usually when you watch a countdown, it's 10, 9, 8, engines ignite, liftoff.
Right.
But today, Friday, June 12th, 2026, the countdown wasn't at Cape Canaveral. It was right at the NASDAQ in New York. I mean, the opening bell just rang. SpaceX, ticker symbol SPCX, is officially a public company today.
Yeah, and the launch pad is just completely engulfed in, well, fire and hype. We are watching the largest initial public offering in stock market history unfold in real time right now.
It's wild. And today's deep dive is entirely focused on cutting through all that historic hype.
Right.
Because, if you're an investor, or even just someone with the standard 401k, the sheer magnitude of today's event kind of sets the temperature for the entire tech sector.
Absolutely.
So we're going to figure out exactly what you need to know right now on day one of trading.
And to do that, we are synthesizing a massive stack of real-time market data, the company's S1, which is, the massive financial blueprint they have to hand the SEC.
Or the mandatory paperwork?
Yeah, exactly. Along with live reporting from the NASDAQ floor, we are also bringing in some highly critical independent analyst reports, specifically a really deep dive into the valuation by Morningstar, just to give you a complete, unbiased picture of what is actually happening.
Because the stakes today are, honestly, they're almost hard to comprehend. We're talking about a fixed IPO price of $135 per share.
Yeah.
And that single number values SpaceX at $1.77 trillion right out of the gate. I mean, they raised $75 billion in capital, which just completely crushes the previous record held by Saudi Aramco.
It does, and pre-market indicators are already suggesting a pop to like $174 a share before the dust even settles today.
Wow.
Yeah, and if that price holds through the close today, the math fundamentally changes global wealth rankings. I mean, Elon Musk would potentially be crowned the world's first trillionaire.
The first trillionaire. That is just... The sheer mechanics of today's launch are completely unprecedented. To understand why the stock is behaving the way it is, we really need to look at how they actually priced this thing, right? Because normally, when a company goes public, Wall Street bankers take the executives on a roadshow. They sit down with huge institutional investors, pension funds, mutual funds, and gauge what they would actually be willing to pay.
Yeah, that is the traditional book building process. The bankers use those private conversations to build an order book and set a sliding price range, sort of matching supply and demand behind closed doors before the public ever even sees a ticker symbol.
Right.
But SpaceX completely bypassed conventional Wall Street mechanics. They didn't offer a price range. They just handed the market a take-it-or-leave-it fixed price of $135.
And the market ravenously took it. I mean, retail investors alone submitted over $100 billion in orders.
It's staggering.
So if you are listening to this and you logged into your brokerage account this morning hoping to snag a few shares at that $135 price, your order probably didn't get filled, which actually brings up a fascinating structural twist to today's IPO. SpaceX allocated 30% of their available float to retail investors.
Let's define what that means, though, because float is simply the number of shares actually available to be traded by the public. Allocating 30% of that float to retail is, well, it's 3 times the normal allocation for a mega cap IPO.
3 times.
Yeah. It is a very deliberate strategic choice. Elon Musk's companies, particularly Tesla, have historically relied on a massive, highly loyal base of everyday shareholders, reserving 30% for retail rewards that base, but, it also engineers a highly volatile market dynamic on listing day.
Because despite raising $75 billion, only about 7% of the total shares are freely tradable today.
Exactly.
The vast majority of the company is locked up, held by insiders and early investors.
Yeah.
Wall Street knows this, and they have already built a casino around this stock before it even started trading.
Yeah.
I mean, I'm looking at reports showing 25 different SpaceX-related exchange-traded funds, ETFs, have already been filed with the SEC.
And we are not just talking about standard funds that passively track the stock. We are looking at double-leveraged long and short products.
Oh, wow.
Yeah, these are funds designed to use financial derivatives to artificially multiply the daily swings of SpaceX stock by 2. Having 25 of these exotic products ready to launch alongside the IPO, it shows how eager Wall Street is to capitalize on the turbulence.
Right.
Pre-IPO funds pulled in over $4 billion just last month from investors who were desperate for access.
So you combine the scarcity of actual tradable shares with these massive leveraged derivative products, and you just get a powder keg. It's like they reserved the entire front row of a stadium concert for the general public instead of the corporate VIPs.
That's a good way to look at it.
But because the stadium only has 7% of its total seats available, there's a massive stampede at the gates. Does this structural bottleneck, like, artificially inflate the day one price? Because I imagine all that unmet retail demand just spills over into the open market today, forcing people to pay literally whatever price is on the screen.
Yes, that unmet demand is precisely what's driving those pre-market indicators up to $174. The 30% retail allocation is historically massive, but it is still just a tiny fraction of the $100 billion in retail demand that actually materialized.
Wow.
So the investors who only got a sliver of what they ordered, or, absolute nothing at all, they are forced to buy on the open market today if they want a piece of the company. The price you see flashing on the screen today is less about the fundamental long-term valuation of the business and much more about the raw physics of supply and demand.
Okay, so we have the physics of the stock market, but we also really have to look at the physics of the actual business. Why are people scrambling for those scarce shares in the first place? What is the engine under the hood here?
Right.
Because looking through the S1 filing, the company operating today looks vastly different from what most people probably picture when they hear the name SpaceX.
It really does. The SpaceX of 2026 is no longer just a rocket company launching satellites and dreaming of Mars. The financial data reveals an integrated telecommunications and artificial intelligence conglomerate.
An AI conglomerate.
Yeah. And the brightest spot in their financial engine, the part actually printing money, is Starlink.
The satellite internet division. I mean, the numbers here are wild. Starlink generated $11.4 billion in 2025. That accounts for 61% of SpaceX's total revenue.
It's massive.
And what really stood out in the sources is that Starlink is the only consistently profitable segment on a GAAP basis.
Yeah, and GAAP stands for Generally Accepted Accounting Principles. It basically means when you strip away the clever accounting adjustments and look at the hard, standardized numbers, Starlink is posting a real, undeniable $4.4 billion operating profit.
That's huge.
It is. It proves they have successfully turned the massive upfront costs of satellite deployment into a durable, recurring subscription cash flow.
But that profitability is heavily contrasted by the overall cash burn of the larger company, right? Because despite pulling in $18.7 billion in total revenue for 2025, SpaceX posted a $4.28 billion net loss in just the first quarter of 2026 alone.
Yeah, and the underlying mechanics of that loss are crucial for investors to understand today. It is entirely driven by capital expenditure.
This is what exactly.
This is the physical stuff a business has to buy to operate. For SpaceX, their capital expenditures are going through the roof because of their push into artificial intelligence and the development of the Starship rocket.
Okay.
After absorbing xAI in a merger earlier this year, SpaceX is burning about $2.5 billion a quarter strictly on AI infrastructure.
A quarter.
A quarter. Things like building out the massive Colossus data center. Then you add in the heavy depreciation costs, which is essentially the accounting reality that those thousands of Starlink satellites in orbit have a limited lifespan and lose value over time, and the profits just vanish.
Okay, wait. I have to push back on the core identity of the company here.
Yeah.
Are you telling me that the world's most famous space exploration company is actually just a giant internet service provider right now, and it is taking all of its telecom profits and burning them in a furnace to build AI data centers on Earth?
Essentially, yes.
So are investors buying a space company today, or are they buying a highly unprofitable AI venture?
That is the multi-trillion-dollar question investors have to answer today. I mean, from a pure revenue standpoint, you are largely buying a global internet service provider. But from a valuation standpoint, investors paying $135 a share are pricing in a future where SpaceX controls the infrastructure of space and the infrastructure of artificial intelligence.
Okay.
They are betting that the massive cash furnace of today builds an insurmountable competitive moat for tomorrow.
It is a massive capital-intensive risk.
Absolutely. If those AI data centers don't yield commercial returns, or, if the cost of the specialized computer chips required to run them doesn't decline as projected, that AI segment could drag the entire enterprise into a cash crisis.
And that immense cash burn is the exact reason independent analysts are sounding the alarm on this $135 price tag. I mean, not everyone is buying into the inevitability of that future. The deep dive into Morningstar's analysis shows a deeply skeptical view of today's valuation.
Yeah, Morningstar ran what is called a probability-weighted discounted cash flow analysis.
Okay, sounds complicated.
It sounds like a textbook term, but it's simply a financial formula. You look at all the cash a business might generate over the next decade, factor in the massive risks of those projects actually working out, and calculate what that future cash is worth in your pocket today.
Okay, makes sense.
Using that methodology, Morningstar arrived at a fair value estimate of just $63 per share.
$63. That is a 53% discount to today's $135 IPO price.
Yeah.
They're essentially saying the stock is worth less than half of what the market is paying today.
Right, and to understand the massive gap between those two numbers, you have to look at the revenue multiple. A revenue multiple simply compares the total value of the company to the total sales it brings in. At $135 a share, SpaceX is valued at roughly 94 times its 2025 revenue.
94 times.
Let's put that in historical context. When Amazon went public, it was valued at 18 times its revenue. Google was at 12 times. Meta was at 22 times. A 94 times multiple has virtually no precedent among mega-cap technology companies.
That is insane. And Morningstar breaks this down even further. They argue that the core business like the space launch division and that highly profitable Starlink internet connectivity is really only worth about $40 a share based on their future cash flows. Which means at today's $135 price tag, investors are paying a $72 option premium.
The definition of that option premium is what makes this IPO so unique. That extra $72 a share is basically the price of admission to Elon Musk's grandest ambitions. You are paying a massive premium for unproven moonshots, rapid daily Starship reuse, the colonization of Mars, and specifically the plan to build commercially competitive AI data centers in orbit.
Data centers in orbit. I mean, the ambition is staggering, but Morningstar ran the probabilities on that specific moonshot scenario succeeding, and they gave it only a 7% chance of actually happening.
7%.
And we are seeing other very real terrestrial risks in those sources, too. I mean, Senator Elizabeth Warren requested the SEC delay this IPO specifically over these valuation concerns. We're just reporting what's in the documents, but it shows the scrutiny this is under.
Definitely. We also have to look closely at Starlink, which we establish as the golden goose keeping the lights on. Starlink is seeing its average revenue per user, or ARPU, drop significantly.
Yeah, the sources show ARPU fell to $66 a month in the first quarter of 2026. That's down from $99 a month back in 2023.
This is a classic telecom dilemma. As Starlink expands its network globally and offers cheaper consumer plans to keep growing its overall user base, the profit margin they squeeze out of each individual user compresses.
That makes sense.
And if that revenue per user continues to compress, or if the multi-billion-dollar AI losses accelerate, that 94 times revenue multiple leaves absolutely zero margin for error. If the growth story stumbles even slightly, the valuation could contract violently.
Let me make sure I'm wrapping my head around the fundamental math here. The earlier analogy about the stadium concert explains the demand side of things. But in terms of what you are actually buying, paying $135 today is essentially paying full price for a luxury penthouse. But right now, it's just a patch of dirt and a blueprint that independent analysts say only has a 7% chance of actually being built.
That perfectly captures the reality of the fundamentals. If you buy at $135, you aren't paying for what SpaceX is today. You are paying for a flawless execution of what SpaceX promises to be a decade from now. You are pricing in absolute perfection.
Wow. But, even if the fundamentals are stretched to the absolute limit, the stock market is also a machine with its own plumbing.
Right.
There are mechanical realities taking effect over the next few weeks and months that could force this stock price to move wildly completely, regardless of what the S1 says or what Morningstar thinks.
This is where the structural mechanics of the market take over, and every investor needs to be aware of the timeline here. The most immediate catalyst is a brand new rule regarding the NASDAQ 100 index.
The 15-day rule. Because SpaceX is coming out of the gate with a massive $1.77 trillion market cap, they instantly qualify to be one of the top 40 most valuable companies in the NASDAQ 100.
Yep.
Under this new rule, they are eligible for official inclusion into the index within just 15 trading days.
Which creates a massive mechanical demand shock. If SpaceX is added to the NASDAQ 100, every single index fund and ETF that tracks the QQQ, which is the massive fund mirroring the NASDAQ, is legally obligated to buy SpaceX stock.
So they are forced buyers.
Exactly the term. These index funds don't analyze the 94 times revenue multiple. They don't read the Morningstar report. If their legal mandate is to perfectly mirror the NASDAQ 100 and SpaceX is suddenly a massive percentage of that index, they must buy the stock to match the weighting.
Wow.
Yeah, if they don't, their fund's performance will detach from the benchmark they promised their investors. It is a purely mechanical wave of institutional capital rushing in.
But right behind that tidal wave of forced buying is a massive potential undertow. The sources highlight a looming supply shock hitting in December 2026 when the insider lockup expires. We have to look at the control structure of the company. Elon Musk holds 42% of the actual equity, but he commands a staggering 85% of the voting power through a special class of supervoting shares.
And alongside Musk, you have early investors like Alphabet and various venture capital funds who have been holding private shares for years. They have seen their initial investments appreciate by 64 times over the last decade.
Yeah, they are going to want to realize those gains.
Exactly. A lockup period is a standard IPO agreement that prevents insiders from immediately dumping their shares on day one and crashing the price.
Right.
But when that 90 to 180-day lockup period ends around December, early employees, the bank syndicate, and those venture funds will finally be legally permitted to sell. Because the valuation is so incredibly high, it could trigger the largest single-day insider selling event in stock market history. The supply of available shares could suddenly flood the market, completely overwhelming the demand.
Man, we also have to talk about the amalgamation trade, because there is a highly tradable, almost weird sympathy dynamic happening with Tesla stock alongside this IPO.
The relationship between Tesla and SpaceX is fascinating for traders. Historically, Tesla stock has reacted inversely to SpaceX IPO milestones. Like when SpaceX announced its confidential filing or when they released the S1, Tesla's stock actually dropped.
It's like a financial seesaw. When SpaceX hits a milestone and looks like it needs capital, the market views it as a diversion of attention and resources. Investors sell Tesla to free up cash to buy SpaceX, which pushes Tesla down.
But the seesaw goes the other way when there is synergy. When Tesla disclosed massive vehicle sales to SpaceX, or when they announced the XAI conversion integrating the AI efforts of both companies, Tesla stock jumped.
Interesting.
When the market sees them as one linked economic organism-sharing technology rather than competing bets draining capital from the same pool of investors, both stocks benefit.
So looking at all these structural mechanics, the forced index buying over the next 15 days, the massive insider lockup expiration in December, if the index funds don't care if the stock is overvalued at 94 times revenue and they're legally forced to buy it in the next few weeks, does this mean the best strategy for an everyday investor is just to surf the wave of forced institutional buying right now and get out before the December insider dump?
Well, that is certainly a thesis some short-term momentum traders are adopting. They view the 15-day index inclusion as a structural tailwind pushing the stock up, and the December lockup expiration as a massive structural headwind waiting to pull it down. But trying to perfectly time a stock with this level of frenzied retail demand, forced institutional buying, and extreme valuation disconnect is incredibly dangerous. The daily volatility alone, especially with those leveraged ETFs amplifying the swings, could easily wipe out short-term bets in either direction long before those structural events even happen.
So bringing this deep dive full circle, today is truly a historic milestone. We are watching the absolute limits of private market valuations being tested in real time. You have an unprecedented $100 billion in retail demand colliding with a fixed price bottleneck, all fueled by sky-high expectations for both orbital AI and space infrastructure.
Yeah.
And every single metric is priced for absolute perfection.
It really is the ultimate collision of market mechanics and futuristic ambition. And the reality is, even if you didn't get an allocation, say, or, if you have absolutely no intention of ever buying an individual share of SpaceX, this IPO still matters to you deeply. Because of that forced index buying we unpacked, SpaceX is going to end up in your 401k. It is going to impact your broad market retirement savings, whether you like it or not.
This IPO is setting the temperature for the entire tech sector. We know SpaceX is essentially the ultimate test case for the next generation of mega IPOs. I mean, companies like OpenAI and Anthropic are waiting in the wings with their own trillion-dollar ambitions, watching closely to see how the market absorbs a giant of this size.
The entire pipeline of artificial intelligence companies is holding its breath today.
Which leaves us with a massive, somewhat unsettling question to ponder as the trading day continues. If SpaceX is the anchor for this new era of astronomical valuations, what happens to the broader tech ecosystem if this $1.77 trillion titan stumbles and fails to defy gravity? Will a contraction in SpaceX drag the rest of the AI bubble back down to Earth with it?
It's a scary thought.
It really is. Well, the countdown is over. The bell is rung. Now we see if the rocket holds together.